Ladies and gentlemen, welcome to the Q2 FY24 result conference call of Ugro Capital hosted by Emkay Global Financial Services. We have with us today Mr. Sachindra Nath Sir, Vice Chairman and MD, Mr. Anuj Pandey, Chief Risk Officer, Mr. Amit Mandey, Chief Revenue Officer, Mr. Kishore Lodha, Chief Financial Officer, Mr. Om Sharma, Chief Operating Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that the conference is being recorded. I now like to hand the conference over to Mr. Avinash Singh from Emkay Global Financial Services. Thank you, and over to you, sir.
Yeah, thank you, Akshay. Good afternoon, everyone. On behalf of Emkay Global, I welcome you all to the Q2 FY24 earnings call of Ugro Capital. I would like to thank Ugro management for giving us this opportunity to host the call. Without taking much of your time, I would like to hand over the call to Mr. Sachindra Nath to discuss the results, followed by Q&A. Over to you, Mr. Nath. Thank you.
Thank you, Avinash. Good evening. I am Sachindra Nath, Founder and Managing Director of Ugro Capital Limited. I am joined by the management team of Ugro, and let me take a few minutes to introduce them to you. Mr. Kishore Lodha, our CFO, Mr. Anuj Pandey, our Chief Risk Officer, Mr. Amit Mandey, our Chief Revenue Officer, and Mr. Om Sharma, our Chief Operating Officer, are joining me in this call. They and the management teams below them are the real strength of this company. We have all a shared vision to make Ugro to grow as the India's largest small business financing company in years to come. This would be my 15th earnings call since we started in July 2018. With every passing quarter, when we reflect on our journey, we get more and more convinced that India needs a large small business credit institution, and we are on the right path to be that institution. Our investor presentation is already uploaded, and I would be referring to the same presentation during this conversation with you. Most of you are always keen to understand the number and then our story. We have now constantly delivered to the promise we have made to ourselves. Our quarterly results are a reflection of starting with a large capital, reinvesting in data analytics, technology, liability, and distribution infrastructure. At the end of FY23, we decided to leverage the established operating infrastructure and deliver growth and bottom line. Our current quarter reflects the same. I'm on slide 3 of our presentation. In H1 FY24, we have delivered 2.2% return on assets and 9.5% return on equity. Slide 4 in the presentation details our key parameters of our business matrix in more detail and articulate our expected delivery on the same on a sustainable basis beyond 2025. Our business now being set to deliver an AUM growth on 30% plus, cost-to-income ratio of sub-45%, credit cost sub-2%, which would bring closer to our aspirational targeted ROA of 4% and ROE of 18% on a steady-state basis in next 2 years. Most of the mainline lenders in India, which are vintage with a large parent or group, have benefit of higher rating and higher leverage, which leads to better ROE. We have been able to establish in India the alternative of high leverage in form of co-lending, and this continues to be the key part of our business strategy, and we would be at an off-book of 50% or higher sooner than expected. If you refer to slide 5 now, while the credit gap for small business and the opportunity is always well understood, the most intriguing part has been that within that set, where is the biggest credit gap and how data can solve that faster. Our targeted customer is the underserved Udyam registered MSME customer in the turnover range of 15 lakh to 15 crore. Studies have shown that out of total 85 trillion credit gap, around 95% is within these set of customers. These customer set are fast adapting to digitization driven by adoption of GST, digital payments, digital banking, and have existing credit history. Over last 5 years, we have mastered the art of addressing the credit for this segment through distinct data lens and not necessarily relying on documented financial records. We have segmented this addressable market through our 5 broad verticals. Our philosophy has been and would remain to build a long-term sustainable portfolio which can deliver sub 2% credit cost, which we believe is a function of yield to loss ratio curve. Within our segment, we are one of those unique companies which addresses the credit need of customers in the yield band of 12 to 18%, with credit cost estimation from 0.5% to 4%, and an asset composition which delivers blended portfolio level targeted credit cost of less than 2%. On slide 6, we have explained on how we address the need of this diverse set of customers from 6 different channels. These channels operate like a set of companies within Ugro framework. Customers with business turnover of 1 crore to 15 crore range are served through our prime branches, which are present in metros, tier 1 and tier 2 cities. We offer prime secured and unsecured products to this set of customers and underwrite them by assessing their GST, banking and cash flow statement of their businesses. In case of prime secured products, prime property of customer forms the collateral. The overall prime segment constitutes nearly 60% of our asset under management. These customers come to us through our 25 branches, supported by more than 900 Grow partners. We target blended yield on secured loan in the range of 13% and unsecured in the yield band of 18%. Micro businesses in tier 3 to 6 cities with an annual turnover of less than rupees 1 crore are served through our micro branches lying in the vicinity of such enterprises. Loan requirement of such customers is typically less than rupees 10 lakh. Cash flow of these businesses have to be assessed through a predefined template by credit officers. We believe these customers are fast adopting to the digital ecosystem and potentially would be upsized in future. These loans are secured by business property of the borrower. The target yield of 20% for this channel. Micro channels constitute 8% of our overall AUM. We have currently 75 branches in 5 states, and in next 2 quarters, we are opening additional 75 branches. We are adding UP, MP, Andhra as new states besides the existing states of Tamil Nadu, Karnataka, Telangana, Rajasthan, and Gujarat. Our ecosystem channel taps in the opportunity of different sets of OEM for machinery manufacturers. Business turnover of this segment largely ranges between 1 to 10 crore range. We believe that this is an excellent white space. This can be expanded quite well and also gives us opportunity to add on cross-sell multiple other loan products to these set of customers in future. In addition to this, more than 20 million retailers in India, which are associated with brands and large corporate ecosystem, struggle for their working capital base to buy and stock materials. We offer supply chain financing across the ecosystem value chain, ranging from suppliers of raw material to retailers selling final products. For underwriting, GST and banking records of the businesses are assessed, while machine and receivable form the collateral for machinery and supply chain financing respectively. Our Grow Stream platform provides support to other NBFCs and fintech to serve the MSME, which are located in remote areas outside the ambit of our prime and micro branches and our targeted yield and credit risk band. Annual turnover of such businesses is typically lower than one served through our branches. Our partners source and carry out joint underwriting of such customers. Our portfolio acts as quasi-secured owing to the FLDG that we collect from our partners. Finally, to serve the working capital needs of small kirana shops and other such enterprises who need instant collateral-free credit, we launched GrowX app last year. These are small loans with ticket sizes of less than 1 lakh. If you look at slide 8, you will be able to appreciate that our early investment into data plus technology, distribution, and liability engine have been able to propel our net loan origination, which has grown from 642 crores in Q2 FY22 to approximately 1,450 crore in Q4 FY23. In this quarter, it was at 1,476 crores. Our origination engine is stable at this range of disbursement, and we would now gradually gear up to increase it to keep in mind the aspiration we have for FY25 without sacrificing on the bottom line performance. The disbursement funnel has taken us to rupees 7,592 crores of AUM at the end of first half of current financial year from approximately 2,000 crores 7 quarters back. Slide 10 and 11 gives you description of our path-breaking credit engine, which is a combination of GST plus banking plus bureau. Its performance continues to make us believe that the future of India's MSME credit lies in the heart of data analytics. We continue to mature our platform with every passing day. While everyone likes the growth, but in credit industry, people also worry about portfolio performance in future for lending company growing at a fast pace. We continue to believe that given our approval rates being below 30%, our portfolio construct of lower to medium yield and balancing between secured and unsecured would keep our portfolio quality stable. For most of our product lines, we have seen the full cycle and they are behaving on the expected lines. So slide 12 and 13 are reflective of our overall portfolio quality. They are diversified and granular distribution. In summary, we have a collection efficiency of around 99%, gross NPA of 1.9%, net NPA of 1.1%, provision coverage ratio of 49%, and a stage 1 asset of 95%. We feel confident to maintain these numbers even going forward. Finally, lending business is more of a liability than asset in India. The asset performance to some extent is a function of liability infrastructure. On slide 16 and 17, details of our liability infrastructure, the most important pillar of our strategy, have been to build large partnership model under co-lending framework. Today, we have more demand than supply. And over last 1 year, almost all of our products are now getting accepted in the co-lending model with the bank. Of the total AUM today, we have rupees 3,405 crores in the form of off-balance sheet assets. Co-origination was primarily with large NBFCs, but now gradually moving with banks under co-origination model, and co-lending continues with some of the large banks in India. On our on-balance sheet liability engine, is now benefiting from having a large number of diversified set of domestic banks, global DFIs, capital market, and large NBFCs. Now we are seeing existing lenders increasing their ticket size with us, and the cost of borrowing has remained stable. Our constant endeavor is now to reduce the on-balance sheet liability cost, which we believe is a real possibility as we gain more vintage. In summary, we have proven our growth engine, we have delivered healthy bottom line, we are maintaining credit quality, and now getting ready to be the large player for credit to small businesses in India. Thank you so much. The management team of Ugro is here to answer any questions. Operator, you may open it for question and answer, please.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. The first question is from the line of Nirvana Laha, an individual investor. Please go ahead.
Hi, good evening, Mr. Nath. Am I audible?
You are audible.
Yeah, thank you so much for the opportunity and congrats on.
Chinmay sir, are you there? Chinmay sir?
Sorry, we lost you.
Chinmay sir?
Hi, can you hear me?
Yes, please go ahead.
Yeah, congrats on another great quarter. My first question is on co-lending. So, we have different products within co-lending, like unsecured loans we're doing now, we're doing machinery financing. My question is, what are the unit economics within co-lending? Is there a particular product that has a higher delta for us? For example, how does it differ between each product within co-lending?
So I think we don't disclose the product level unit economics, but I can give you a broad guidance. If you look at our on-balance sheet cost of borrowing, it's roughly around 10.5. On most of our co-lending products, except the unsecured business loan, the spread to us is superior to our on-balance sheet cost of borrowing. The reason for that, the way it is beneficial for the company, is that we earn the spread of, let's say, 5%, 6% on balance sheet, while we have to provide for at least 20% of the capital. On the co-lending side, you earn more or less same spread or more spread without providing the capital. That's why it's very capital efficient business model. The reason why the spreads on the co-lending are superior, because for banks, the risk weight to lend to an NBFC for our rating band is say 100% or 50%, while the risk weight for underlying customer segment of ours is far lower. So at the credit cost adjusted, OPEX 0, banks having the cost of capital of less than 5%, actually it is far more attractive than lending to an NBFC. So the core hypothesis of co-lending in India is that banks can undertake and originate investor segment without incurring OPEX.
Got it. My second question is with our deal with SBI. I believe, in the starting stages, there were some teething issues, and I heard from them that they've onboarded a tech partner to sort of help with integration. Could you give us an update on how things are moving now compared to where things were a couple of months ago?
So I think you should look at co-lending, and I will not like to comment any specific bank partner or their technology provider or the vendor of that. But I think you should look at it in the context of this. The securitization industry in India started in 1982. The first securitization transaction was done between Shriram Finance and Citibank way back in 82. And for it to reach to 4 lakh crores, it has taken almost 4 decades. While the co-lending in the first 3 or 4 years have reached above 75,000 crore in aggregate in a year's time. So I think the speed at which the co-lending is growing in India is exceptional. Obviously, as an originator of asset and bank as a buyer of this asset, we all would like, we say, dil mange more. And the second is that we should look at it the co-lending and its progression in this way. The bank's understanding of the customer segment which we serve, and to begin with, was their understanding, while we do it in a very different way. So to bring into the alignment wherein the banks understand our credit, the risk, the product, the policy and philosophy, and bring it at par, have been a journey. It has taken us 2 to 3 years. But I would say at different banks are at a different level, but some of the large banks, some of them which you have named, have accepted Ugro's credit methodology, I would say up to 95%. Second is the technology aspect. So as you know, the banks have their technology engine and we have our technology engine, and they are intermediary platform in between which are integrating with 2 of the partners. And that again is at this point of time is an evolution of journey. I think some of the technology players are working very hard to create this as I would say, 100% smooth journey. Today it is more or less in a hybrid form, but each bank and each partner are progressing fairly well. I'm quite confident by end of this year and next 2 quarters in next financial year, you will see almost 70 to 80% efficiency rate when it comes to the technology integration. And after that, you should see even further explosion of co-lending industry in India.
Okay, my last question is on the cost to income this year. Like we were hoping to see, with no branch expansion this quarter, that we'd see operating leverage play out. But actually, quarter on quarter, the cost to income hasn't fallen. Could you tell us why this has happened and where we expect the end of the year, to fall on this?
Vishal, you want to take this?
Hi. So cost of income ratio has been constantly reducing for the organization. So if you look at the past data, 2022, the cost to income ratio was 72%. Last year, it was for the full year, it was 64%. And now we are closer to 55-56%. Though the cost to income ratio, we expected it to be slightly lower by first half, which is slightly 2-3% more than what we expected. It is not because of any business function or yield function. It is largely on the premise that for some time we are holding on some amount of liquidity on our balance sheet, which obviously gives some comfort on the business line, some comfort on the lenders, but at the same time has a negative carry. So which has some impact on cost to income ratio because the NIMs become lower compared to whatever negative carry is getting generated. So what we have guided at the beginning of the year that we should be closer to 50% in terms of cost to income ratio, which would be still lower by almost 10-12% compared to previous year. We still believe that we at the end of the year will be closer to 50-52% kind of cost to income ratio.
Got it. That's all from my side for now. Thank you.
Thank you. The next question is from the line of Rahul Bangadia from Lucky Investment Managers. Please go ahead.
Thank you for taking my question, sir, and congratulations on a very good set of numbers. Two questions. First one is actually just a continuation of the last one on the cost structure bit. We have seen an 18-20% absolute cost structure rise Q on Q. So, but you have already guided for a 50 to 52% kind of cost to income ratio depending upon the balance sheet side, but that is from the balance sheet angle point of view. The absolute number itself has grown at a 20% Q on Q or an 18% Q on Q number. Some sense on that, sir?
Again, I would like to take this question, Rahul. Thanks for asking this. Actually, if you look at our numbers, two places you would see some rise compared to the previous quarter. One is on the employee cost, which was closer to 37 crore, which has moved to almost 46 crore this quarter, and other operating expenses have moved by almost 3 crore from 25 crore to 28 crore this quarter. So as far as the employee cost is concerned, there has been no addition on the employee cost or no increase in overall wage cost per se. But what has happened that in last year we have provisioned for almost 12 crore on the employee bonuses. Actual bonuses which were distributed during the first quarter of the year for the last year performance was 7 crore. So there was a saving of 5 crore, reversal of 5 crore of bonus which has happened during the last quarter. And this quarter we have made a provision of around 2.5 crore rupees for the this year's bonus, which will be actually paid for during the next year. So if you take these numbers out, then we are flattish as far as employee cost is concerned. So there is no addition of manpower, and neither there is addition of manpower nor there is an increase in manpower cost per se. On other operating costs, we are slightly more compared to the previous quarter by almost 3 crore. Most of it has come because of the GST reversal. As an NBFC, we are entitled for only 50% of GST, so 50% is the charge that comes from the on the P&L for whatever services we take. So this increase of almost 3.5 crore, 50% of that has been contributed by this GST reversal, which is a charge. Hence, on operating side, actually there is no significant increase in operating costs, and whatever budget we have taken for the full year, we are fairly confident that on the operating cost side, we will be either same or lower compared to whatever we have guided for.
So, sir, if I have understood it right, in Q1 FY24, there was a reversal of a bonus element which you would have accounted for in FY23. Is that understanding correct broadly? That's what you have done?
No. So the FY23, yes, you are right. So FY23, we have made a provision of 12 crore for this year's bonus, but actual bonus distribution was 7 crore.
Right. So, okay, so that explains one part of it. Now, two smaller questions, sir. Do you, initially we were targeting an AUM broadly of about 10,000 crores as we end this year. That, kind of we are on track for that?
So, I would let Amit answer that question, Rahul, but I think the one thing we always put out a very high aspiration number. So our aspiration number continues to be 10,000 odd crore. But over last 1.5-2 quarters, we are focused. We are tightening the ship. We are keeping our operating costs flat. We are making sure that on every product line our yield increases. And even if we have to sacrifice 500-600 crore of AUM on that, but we improve the PAT by certain basis points, we would do that. But broadly, we are in line with our aspirational target of 10,000 crores. And guided by 500. We are currently, from our planned number, we are short by 300 crores, but we are pushing all paddles to get to where we want to. Amit, you want to add something?
No, Sachin, you put it very aptly that we are on. So rightly said, we are about 280 crores short of our plan as of this quarter on a total AUM of 7,600 crores. However, in next 2 quarters, we should be able to track as per plan, and we should be there as close to 10,000 crores with a deviation of 3-4%.
Great, sir. Just a small clarification I needed on your presentation, then I'll come back to the queue. Slide number 12, you generally give a product mix and the interest yields across the products. There seems to be a big drop in the partnership and alliances yield this quarter from what we have seen in the previous quarter. Just a typo, or should we understand something there?
No, I think so we used to give the gross yield. So if you look at the partnership alliances, our customer, obviously, when we lend to the end customer, there is a gross yield, and then we pay a service fee or interest sharing with the partner. So I think that this time we have actually given the net yield, if I'm correct. Akshay, is that right?
Yes, sir.
Okay, so the only difference is that in the partnership and alliances yield, you have just cut out the portion that the partner takes away.
Yes.
Thank you for answering those questions. Thank you very much.
Thank you. The next question is from the line of Nilesh Sahar and from Julius ER. Please go ahead.
Hi, am I audible?
You are very well audible, Nilesh. Thank you.
Okay, thank you so much. So I would like to, would like your help in understanding the go-to-market strategy that you have. I think you mentioned in your presentation that you have 95 branches and you are not looking to expand your branch footprint. Is that right?
So we have, in my opening commentary, I said that today we target the customer segment of 25 lakh turnover to 15 crore turnover. We target the customer band between 12% yield to 18% yield. We maintain a healthy portfolio mix of secured to unsecured because we believe that delivers a defined credit cost. And we go to these customers from 4 different distinct channels. Branches divided in 2 parts: prime branches, which target the prime customer in top 25 cities; 75 branches for micro enterprises, which is direct distribution. Then we have ecosystem in which we do machinery through OEM. We do retailer financing through large anchors. Then we have a partnership and alliances channel where we do along with other fintech and NBFC. And we have a new channel which is called GrowX, which is a direct digital distribution ecosystem. So that's the way the funnel is. With respect to branch infrastructure, we believe that in order to get the desired yield, the ROE, we have to expand our physical footprint. Our 75 branches, which were started in 21, 22 are now peaking their peak productivity, almost 70-80 lakh rupees per branch. And that's why next 2 quarters, we are adding another 75 branches, and we are added 3 states. We believe that the incremental OPEX to that, because most of these branches, by the time they will come up, the year would be passed by. So the incremental OPEX to this year financial performance would not be there. And next year, our size would be larger enough to absorb this cost, but the benefit from a higher yielding secured product, which we want to expand now.
Got it. Just if you could describe, how the structure of a branch looks, right? Because it seems to me that that you guys are doing a lot, both in terms of the number of industries, the number of products, right? How these products are funded, right? So what does the typical, workforce in a branch look like? How many people are doing sourcing? How many people are doing collection? How many people are doing, credit? Can you help us understand?
I think it's a very long conversation, and we'll be happy to do a session with you separately as well. But I think it's a function of, setting up for scale. I think 2 quarters back, I was giving somebody this example that if you start a geo convention center in BKC, you will end up with a first event of 5 lakh people versus starting a boutique hotel and having 100 people. So that's the philosophy. A company which started with 1,000 crore of equity capital is started one of the most established management team with the largest liability infrastructure and which has an aspiration to build India's largest small business financing company would, on the face of it, would look like we're doing a lot, but we are being able to do a lot because that's the infrastructure which we have put in first place. Philosophically, we drive our business through a data lens, which we call growth score. Ugro has India's one of the largest data analytics plus technology team of 275 people. Then we have Then we have a sectoral view that we look at the customer below our data engine through lens of 9 sectors and 100 subsectors. That gives a templated method of underwriting for our different customer sets. And then we have these 5 distinct distribution channels run by separate management teams. And there is a common liability infrastructure which borrows on balance sheet, and some of our asset lines get funneled into the bank. So in summary, this is what would drive or deliver what we call the 30% CAGR growth rate, cost-to-income ratio of less than 45%, ROA of 4%, return on equity of 17-18%. So I think this is a 5-year of hard work through which this large format business has been established in India.
Just one last question is that from a collection point of view, how are you guys organized?
Amit, you want to take it?
Yeah. So we have a large collection team, in-house team of approximately 250 people, and it is organized broadly between 2 verticals. There is a large on-field collection team, and then there is a large in parallel litigation team. And depending on the size of portfolio in each location, these collection teams are further subdivided by buckets and by products. They are all headed by a very senior which we call head of collections and litigations, and under him there are 3 national level positions: national collection head for secured loans, national collection head for unsecured, and a head of litigation.
So most of it is done in-house.
Yes.
Yeah, all of it is done in-house, but I think our collection infrastructure is a function of our choice of the customer profile. 100% of our customers are not new to credit customer. They are what we call the underserved segment of the credit market. They all have some kind of history of the credit, and all of them come through the banking system. So 100% of our collection happens through banking system, and depending upon the product lines and at different stages, different collection teams on ground do the collection. But our collection is also powered by what we call a very, very established early warning signal. So our data analytics team not only does the credit underwriting platform at the point of origination, but also provide an EWS system which gives input to our collection so that we have a proactive collection system. And now our data analytics team also is looking at cross-sell with the product. So our collection engine is fairly, as it could be for any bank or for any large format NBFC. It's a combination of digital infrastructure, combination of physical footprint in our branches, and automated collection engine through banking system.
Thanks a ton. Yeah, and I will touch base with you guys separately for a deeper conversation. Thank you.
Please do that.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
So just two questions. One is, how often do you scrub the data of your borrowers for they taking any form of fresh credit once they have been onboarded as a client?
So for our existing customers, we do a scrub once a quarter.
And if you could just tell us what kind of trends are you seeing from the scrubs?
So primarily we use the scrub for two reasons. One is on our early warning signals, and we do an on-book and off-book comparison and try to ascertain through a machine learning platform whether the overall leverage of the customer is going up or down. And second, we use the scrub in ascertaining and refreshing the probability of default of the customer for the next 12 months. So what we are observing now is overall not much change. The turnovers of the customers have gone up in our chosen target segment, and the leverage overall is also going up around the same pace.
Okay, and you are seeing, say, instances where multiple lending is becoming common, or it still remains the same as what it was probably about a year or 2 years back?
So we were always we don't fund new to credit, so we always fund customers who already have a credit line. So in terms of number of trade lines at the time of onboarding, we haven't seen too much of change.
Okay, so you don't see this as a risk. You don't see the current set of developments that is coming in the media as a source of risk, where there seems to be a lot of multiple credit lines being issued by the customer.
No, that is more for consumer loans. In MSME, we are not seeing any such trend.
Okay, perfect. Thank you.
I would, Mahesh, I'd like to add one more thing. I think so. The conventional way to look at MSME credit versus the way we look at it is slightly different. Yeah, as I said that if you look at our slide, I think 12 and 13, you see there is a proprietary tool of us, what we call the growth score. Our growth score actually is built around the repayment capabilities of a customer, which also takes the tenacity of the turnover and cash flow which comes out of the banking. And then it categorizes our customer in 5 different risk bands. We are on the version 3 of our growth score. We also show its performance for both set of our customers. So while we scrub the bureau for our existing customer every quarter, but we also scrub for all the customers which we have not lent to. And then we compare that how the performance of our score have been. And because we predominantly rely on the difference, what you see the media noise around the unsecured loan versus small business loan, unsecured consumption loan doesn't take in account the repayment capability because you're funding predominantly a consumption purchase versus our lending is purely dependent upon the repayment capability. So every time machine calculates the eligibility of the customer, and if it is an unsecured loan, it discounts the cash flow, presuming that there will be multiple lines of credit along with us or outside us would be coming to the customer.
Perfect. So Nath sir, just to kind of extend that argument, given that the SME borrowers' cash flow at the company level and at the individual level are largely interchangeable, you don't see it as a risk right now that while it may not be showing in the corporate balance sheet or the SME balance sheet, it may be seen in the personal balance sheet of the consumer.
I'll let Anush give you a detailed answer, but I would say it depends upon, what's your target customer segment. What you are saying is for the SMEs which predominantly banks customers, the customers which are in the turnover range of say 25 crore to 100 crore per se. In our customer segment, as you go much granular and deeper, actually, most of our businesses are either proprietorship firm or partnership firm or a portion of that are companies. This interchangeability doesn't impact that much because we are our credit is dependent upon the cash flow which we are analyzing through system for the business entity per se. And as long as we are more conservative to that extent, and if we're taking more credit at a personal level and then deploying in the, that get reflected in bureau, because we fetch the bureau of the customer, we fetch the bureau of the entity, we fetch the bureau of the individual which are associated with the entity. So our system to some extent undertake that as well. Anuj?
Yeah, you're right, Sachin. And just to add, and specifically in case of proprietorships, where the proprietor's personal consumption would get reflected in his consumer bureau, our growth score has been designed to take that input also into account. So when we are now scoring the customer, especially for proprietorships, we are also additionally looking at the proprietor's consumer bureau as well. So in a way we are taking into account any additional risk if he's taking at his personal level.
Perfect, sir. Thanks a lot for this.
Thank you, Mahesh.
Thank you. Ladies and gentlemen, in order to ensure the management is able to address questions from all the participants in the conference, please limit your question to 1 or 2 per participant. Should you have a follow-up question, we will request to rejoin the queue. The next question is from the line of Omkar from Vasuki India Fund. Please go ahead.
Hello.
Yes, Omkar.
Yeah, so I just wanted to, go back to the guidance part. So for 24, we had a guidance of around 3% for ROA, right?
Sorry, your voice is not very clear. Can you come back?
Yeah, I just wanted to confirm on the guidance part. So for FY24, we had a guidance of ROA of around 3%. So are we maintaining that, or is there any change?
Sure, are we maintaining that?
Yes, we are reasonably confident that we would be able to achieve 3% of ROA by the year end. So there is no change on the guidance on that part, because whatever we have as far as ROAs are concerned for first half, whatever we have planned for, we have achieved it to the T. So at this moment, there are no indicators which lead us to believe that there would be any change in that kind of achieving that kind of ROA. So we firmly believe that we should be able to achieve that kind of ROA.
And any updates on the fundraise?
Sorry for the interruption. Mr. Omkar sir, your voice is not audible. It's very low. Can you please switch to the handset?
Yeah. So I was saying, is there any update on the fundraise part, on when it would be and how much?
So, as we have answered this question, Dasan, we are very well capitalized at this point of time. We have a 25% capital adequacy. We have multiple tools of getting our portfolio covered under credit guarantee. We have not used any tier 2. Our stated objective is to make Ugro as a well diversified, well tracked listed public company. And with that objective, we would like to tap public market for our next round of capital. We are in no hurry to do that. I think so for the first time, the management is putting an effort to explain our broader story to public market investors. And that journey we have started around a few months back. And we will continue to do for next 2 odd quarters. And whenever we think that our existing shareholder and board is comfortable with the price, with the capital raise size, and when the market is ready to provide us the capital, we will do that.
Okay. I'm sorry, I missed the branch expansion piece. 75 branches you are planning over how much time?
So our target is to get these branches more or less activated by end of this financial year. I think so they will become productive gradually in Q1 next financial year. While we started the process, but we are making sure that they are not accelerated at a pace wherein it start hurting or it consumes our bottom line. But also we have an eye on how our FY25, 26, 27 would be, and that's why we are seeding the investments gradually. Because as you know, the micro branches is the highest yield generator and best portfolio quality creator for Ugro. So keeping that in eye, these branches I think should be at least at a stage of becoming productive by end of financial year.
And how much time does a branch take to break even typically?
Micro branches take between 12 to 16 months to break even.
Okay.
But the cost will be fairly low.
Okay. Got it. Thanks. Congrats for the great set of results. That's all from my side.
Thank you, sir.
Thank you. Next question is from the line of Rahil Shah from Crown Capital. Please go ahead.
Hello, sir. Good evening. Earlier, to one of the participants, you mentioned, so you asked about the AUM aspiration of 10,000 crores by year end, and you said that you are ready to sacrifice a certain amount of AUM in order to achieve a certain PAT target. So, have you given us any guidance for the PAT for this year, or would you like to, repeat if you have?
So actually, a lot of people keep advising us that we put very hard numbers of what we would be doing in next year onwards. And most of the people say we should always give a band, right? Because public market investors, if you don't give them a hard number, and if what they expect and you overachieve, they feel very happy. But if you give a aspirational hard number on you suboptimally achieve, then they don't like you. So I think we are becoming gradually cautious around what we say. But as a team and as a management, we are motivated by the size of the opportunity which we have in front of us. We always believe that the only way to capture that opportunity wherein we publicly commit what we want to build, and that's why we put those hard numbers. But what I was referring to, that you don't hold us to the last T if we miss 5 or 10%, because these businesses are being built for generations, not for a quarter or 2 quarters or a year or so. So our guidance to the total bottom line, so as would be, we have done around 55-56 crore for the half year, and we should be doing more than what if you multiply for next half, we should be at least 20% above that is our guidance. On the AUM side, we are still saying that we will target to achieve what aspiration numbers we have put out. But if we have to make sure that in order to get to the gross AUM number, if we have to take a reduction a little bit on the yield and the profitability, we won't do that. So that's the guidance. Right? We are still targeting that number, but if we miss by 500 crore but we maintain our profitability, we are okay with that.
Got it. So, like 20% more than what you have already done in the first half. Is that correct to understand? Is something you're targeting?
Yes, sir.
Okay. And lastly, just you've given other guidances for the year as well. Just want to know your advances growth. What do you expect to close this year with? And that will be my last question.
We answered just that if we have said that our end AUM was in the range of between very close or near to 10,000 odd crore, between 9,000, anywhere between 9,000 to 10,000 crore, it should be there. Hello?
Yes. Thank you.
Hello?
Thank you and all the best.
Okay, thank you.
Thank you. The next question is from the line of Pruthul Shah from Anubhuti Advisors. Please go ahead.
Yeah, am I audible?
The person you are speaking.
Hello.
Pruthul Shah?
Yeah, am I audible?
Yes. Please go ahead.
Yeah. My question is with respect to the collection efficiency ratio of the current month that we brought in the presentation slide 13. So if you see last 1 year, that has gone to 92 from 94. So I just wanted to know that what is the comfortable level for us as a company for this current month ratio, and also in that context only, because currently the concerns are going on with respect to the unsecured or the
lower ticket size loans. So what is our view on that aspect? Because we have that lower ticket size loan book, and we basically cater to the retail or smaller businessmen as a company. So what are the trends that we are looking on?
So I'll take that. Collection efficiency in isolation actually doesn't give the full picture. For the correct perspective on the portfolio, one should look at collection efficiency in tandem with the bucket resolution rates. So a 92% on current collection efficiency is fine if the bucket X resolution rate and bucket 1 resolution rate are in accordance to what the plan is. So if in our case, the bucket X resolution rate is 95% plus and the bucket 1 resolution rate is 80% plus. That along with the 92% collection efficiency is what is quite decent. On the second question, especially on the smaller ticket unsecured loans, while our gross score is stacking up quite well, additionally from last quarter, we have decided that we will take the credit guarantee coverage offered from the government through SIDBI. So you might be aware that all loans under 10 lakhs, if they're unsecured, they qualify additionally for a Mudra guarantee scheme from the government, and all our loans are eligible. So when you pay a premium of approximately 1% of the loan amount, you get a guarantee coverage which is almost unlimited. So in addition to what our gross score is doing and our overall collection and EWS strategy, we are now also covering the unsecured loans through a central guarantee.
Okay, got it. I take this in offline. And also another question with respect to the yield that we have provided in the presentation. So for H1 we have provided 17.4%. So is that the realized yield or is it the blended on the outstanding book as on September 23?
So this is the blended yield on the AUM. So I didn't get the question. So the realized yield and the blended yield on the AUM should be same. So what exactly is the question?
I'm just asking that 17.4 is the yield that we have realized in first half of 2024, or this is the rate that we have calculated on the outstanding AUM as on 23?
Yeah, so it is calculated on the outstanding AUM as on 30th September. So various products have various rates. So Sanjeevani would be in the range of 13.5, and unsecured would be in the range of 18.5. So put together the entire weighted average would be, realizable yield would be 16.2% on net basis, and while reducing the partner's margin. And if we take partner's gross margin, then it is closer to 17.3.
Okay, got it. So one last question, what would be the ESOP of FY24?
Excuse me, Pratul sir, your voice is not audible. Can you please repeat again?
Yeah, my question is with respect to the ESOP cost. So for H1 at 24, what is the total ESOP cost?
So ESOP, as far as ESOPs are concerned, we have two schemes which are running now. So most of the people which are now are on that. One which will be vesting in 2025, for which the entire charge of roughly around 25 crores was taken hit in the capital in the last year itself when we created the ESOP trust where we purchased the shares. So there is no fresh hit on account of that portion. And on the other side, it is as per the model which we follow. So every quarter the model is refreshed, and whatever the charge comes in, it is being taken in the P&L.
So can you provide that number? What was the charge in first half?
It should be around 1.5 crore. It should be in that range for the first half.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Nirvana Laha, an individual investor. Please go ahead.
Hi, good evening. Am I audible now?
Yes, sir. Please go ahead.
You are audible.
Okay. So my question is on co-origination versus co-lending. So Mr. Nath, you said that with some banks you're also now doing co-origination. So just want to understand, how is this decided? Like, is it on a partnership basis that an entire partnership will be completely co-lending or completely co-origination, or can it be on a loan portfolio to loan portfolio basis? So how is this decided and who decides it?
We decide it, and it is basis how the entire understanding of a partner or evolution of a partner happens, right? So if you look at our co-origination portfolio, which we largely do with the NBFC, so most of it, I would say, 80-90% of that is what we call the unsecured business loan segment. Why it has happened that started largely with NBFCs and now gradually moving towards banks is for two reasons. First, banks, when they started co-lending in India, they were more motivated to undertake, because they didn't know what an NBFC does, underlying customer segment. They were more attuned to take only what we call the loans backed by physical collateral. And as we have progressed with our relationship, and also one big change happened that the credit guarantee scheme was extended for co-lending. Banks are also now accepting the business loan segment also under co-lending arrangement. We got these NBFCs because they are more or less in the same segment of the market. They could appreciate and understand our underlying business loan segment, and they were also driven by the fact that we could provide them some kind of a first loss cover, which we felt is a good way to attract capital for that segment of the market. Third, but last but not least, is that co-lending is also driven by technology, integration infrastructure, because under the co-lending arrangement, wherein I go source the customer, disburse 100%, then that loan file through a technology platform moves to the bank. Bank on every agreed parameter basis check the file and then disburse me back or reimburse me 80% of the customer. The customer is fully disbursed at the first hand. Versus under co-origination, the bank and NBFC have to lend together. Now that is a very cumbersome process of a large bank and an NBFC doing it together. But we are gradually, given the advancement in technology, the integration and understanding, we are now moving towards an era wherein bank and NBFC would be able to do co-origination together. So I think that's how so the choice of the partner is their understanding of a product. We decide where we get the best price and which partner can do it more efficiently. And eventually the larger, as we progress and as our portfolio performance, the customer segment, the product is understood by the bank, most of our asset engine would funnel to banks. But there will be certain, products which banks would still take time, and we will continue to do with partner NBFCs which understand those product segments better than what banks understand.
Got it. So from Ugro's point of view, for a particular relationship with a bank or an NBFC, depending on profitability, you would want the loan to go under a certain model if it's acceptable to the counterparty. Is that understanding correct?
Yes, to some extent.
Okay, all right. Next question is on the collection efficiency. So the numbers for the last 3 months have been around 92%. I'm talking about the same period. So that means that 8% slips to the bucket. But when we look at stage 2 plus stage 3, that combined is around 5%. So from what I can understand, about 3% is getting resolved within the first 30 days. Correct me if the understanding is wrong. But if that understanding is correct, then my question is, isn't the customer taking a hit on his or her CIBIL score due to this delay? Whereas he's paying quite soon, but still it's overdue, right? And is Ugro doing anything to change this customer behavior? Because when I look at your peers who may not be exactly lending to the same cohort, but they are MSME lenders like 5-Star or SBFC. They have much higher, same period collection efficiencies, and this behavior of a slightly delayed payment doesn't seem to be there. So I've been trying to understand what is causing this for Ugro, if you have any insights, and whether it actually affects the customer's CIBIL or not.
So, you asked many things, so I'll attempt one by one. First, it is not a simple algebraic addition of correspondence between the collection efficiency number and the stage 2 and stage 3 assets. Because in stage 2 and stage 3, there are more than one EMI pending. So even if you collect one EMI from a stage 2, let us say there is a stage 3 asset where there are 4 EMIs pending, and you collect one EMI, then the customer continues to remain in stage 3, but the collection efficiency on current dues will go up. And the vice versa logic is also equally applicable. So one should not simply add and see, but broadly your point is right. For an MSME customer, typically, and it is a function of, and we also keep doing that as a lender, we need to educate him. But in his mind, the month of payment is important, not the date of payment, typically for micro customers. So if the due date is, let us say, 3rd of every month or 7th of every month, then as per the new regulatory guideline, on 8th, the DPD will start running, and in case it is becoming a stage 2 or a stage 3 asset, it will get tagged that way. But in the customer's mind, it is the month of October, and he has to pay that money in the month of October. So at times, his CIBIL report will also be accordingly. This is a large exercise which we need to do across all lending institutions who are focusing on MSME to educate the customer. But it is also a function of his cash flows. Lot of times, the cash flows are not predictable enough for him to be ready on the due date. But as long as he's paying in the due month, it is okay.
Okay, got it. And if I may, just one last question from my side. I heard you saying that you're also thinking of availing the Mudra guarantee scheme for customers less than 10 lakh lending ticket size. What percentage of AUM would that constitute as of today for you? And would you be doing that for all customers under the unsecured business loan in that segment, all of them, or only selectively?
So last quarter was the first quarter when we started this, and the intention is to cover from now onwards 100% of our unsecured portfolio under this.
Okay, and what percentage would that be as total AUM?
% of the portfolio is covered.
So as of September 30th, we have covered 10% of our total portfolio.
Okay, and all the customers who don't go through the gross score model, are they all now covered under this scheme? Because that was a gap, right?
That was a gap, which is primarily the micro customers' unsecured bit. So they will also get 100% covered. Yes.
Okay, that's great to hear. Okay, thank you so much for patiently answering, and all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to one per participant. Should you have to follow-up question, we will request you to rejoin the queue. The next question is from the line of Sanjay Kumar from iThought PMS. Please go ahead.
Hello everyone. First one, just a clarification. Why has the ticket size in supply chain financing dropped from 1 crore to 50 lakhs in just 1 quarter? Is it because of the, say, we onboard a large anchor?
So, let me take this question. On supply chain, we've been constantly evolving towards 2 things. 1, more granular supply chain business. Second, higher yielding supply chain business that is there with some the opportunity that's there with some anchors. In this whole quest to make it granular and to ensure that we do better quality portfolios, we've migrated towards newer set of anchors where we are servicing. Apart from that, we are also now building our last mile retailer financing solution, which is also leading to the ticket size drop. So you're right. It's moved. That's because the number of customers on retailer financing and the granular financing is suddenly doubled. The ticket size has dropped on supply chain, and it's only in the interest of a better portfolio which helps us manage the granular portfolio better and have a better view on the supply chain that we're migrating towards a granular and a high yielding portfolio.
Perfect. So thanks for that. And second, on prime unsecured, I don't know if you addressed this in the opening commentary. The prime GNPA in prime unsecured has jumped from 3% to 3.5 QOQ, and the same with even micro enterprise loan from 1.1 to 1.7. What is driving this? I know at least the micro enterprise is covered under Mudra. To that extent, it will be secured. But what is driving the jump in GNPAs?
No, so it is the jump in GNPAs actually has been planned. It is a function of the seasonal portfolio's contribution in the total portfolio. So overall, when we do a lifetime budgeting of NPAs for unsecured, our budgets for lifetime is around 4.5% to 5%, which roughly translates to about 1.5% of an annualized credit cost. So we are now slowly reaching there. We expect the unsecured GNPAs to stabilize between 3.5% to 4% going forward.
Okay. And on micro enterprise, sir?
On micro enterprise, lot of that is actually secured by property, and it is so currently that cycle of recovering and repossessing the property and then selling it off is now in action. So you will see that it will also stabilize at around 2% in next 1 year. The unsecured portion of micro, as I was telling earlier, is now getting covered under Mudra.
Okay. And how much of the micro enterprise is?
Interruption. Mr. Sanjay Kumar sir, may we request that you return to the question queue for follow-up questions?
And then we can take up your question separately as well if you want.
The next question is from the line of Akash Jain from HCon Global Service Limited. Please go ahead.
Congratulations, sir, on a very good set of numbers. My question is regarding credit cost. We have given a guidance of around sub 2%. So I wanted to understand, as the stage 3 provisioning coverage is around 49% on book AUM. And once the portfolio gets seasoned out, especially in the unsecured book, would there be any provisioning requirement going forward? Because if the provisioning requirement goes up, then the credit cost will not come down.
So out of our approximately 49% provision coverage on stage 3, the stage 3 consists of all kinds of assets, including secured and unsecured. Only on unsecured, the broad guidance which we are following is to cover at about 65%, and we will continue it that way. So all our credit costs budgeting estimates have been done accordingly.
Okay. That is all from my side.
Thank you. The next question is from the line of Anil Tulsiram from Contrarian Value Edge. Please go ahead.
Yeah, thanks a lot for taking my question. Sir, my first question is, over the last 8 quarters, our co-origination book is growing relatively faster compared to co-lending. So will the mix between the two will impact your ROA and the fee income? So actually what I'm trying to understand is the particular product, whether you do under co-lending or co-origination, will the ROA will be the same? And the related question is, can the banks also can do the co-origination? Yeah, that's the first question.
Kishore, you want to take this?
Sure, sir. In absolute terms, in co-lending, the ROA would be higher because as per the new accounting standards, it is akin to DA, where the lifetime income at NPV you have to account for. But we are very focused that we should have significant amount of annuity income where co-origination really helps. So we are quite comfortable at this level of co-origination as well, because co-origination you get an annuity income for the life cycle of that loan, while in co-lending you have to upfront the lifetime income at NPV. So it is a healthy mix which is there, and we will like to continue to have this way. Only change where Sachin was alluding to is that we would like to move it from NBFC to bank gradually. Initially, banks were not ready for CLM1 model where they would simultaneously co-originate with NBFC. It is because of two reasons. One is on the tech readiness, and second is on the mindset issue. But now both the things are getting resolved. Banks, especially the public sector banks, are getting ready for doing CLM1 as well, and now they don't have this inhibition that doing CLM2 is anyway superior compared to CLM1. So they understand that it is all the same whether you do CLM1 or CLM2. So both the things are getting addressed. So now we have to tie up with banks where we are doing CLM1. So gradually going forward, we would like to see that we move this portfolio of co-origination to some extent to banks. So that is the only change we are taking. Otherwise, we are quite comfortable with the mix which we have on co-origination and co-lending and DE.
And my last question, then I'll join the queue. See, our target is to reach 20,000 crore AUM. So I'm not bothered if it is get delayed by a year or two. Actually, what worries more is whether the PSU banks will give us enough limit on your co-lending or the co-origination. So how the management thinks about this risk internally? That's my last question.
So, sir, if you look today, actually, we have, at least for next many number of years, we have more capacity than what we can service. So if you look at the entire banking industry in India, we have 12 public sector banks, and we have around 7 or 8 private sector banks, which are quasi-public sector banks, which are largely south, and then the private sector banks. We targeted first with the large banks, so like the State Bank of India, the Bank of Baroda, and others, whose capacity is actually mammoth. So for a State Bank of India, stated objective last year was to do 10,000 crore of co-lending, but they hardly achieved 1,000 odd crore. So actually, their capacity, so of the 56 lakh crore of a State Bank of India, their capacity with a good partner is more than 10,000-20,000 crore as well, right? Then the newer other public sector banks and the newer banks which are in the private sector, I think so. Banks have now come to realization that besides the priority sector requirement and fulfillment, co-lending for the banks is also a great ROA generator. At their level, credit adjusted basis of 5% NIM for a cost of capital of 5% for a bank and a leverage of 12 to 15%. This is a very great product line. So banks are now actually chasing more co-lending partners than what is today. So my view is that by that logic, the securitization volume in India have never dropped. It has always been there, and it is some form of a securitization. It is getting replaced from a portfolio basis acquisition to an on-tap acquisition. So I think that for our size up to 30,000-40,000 crores, I don't see this as a challenge. And we are diversifying to more banks. That's why we are not trying to be dependent on just one.
Yeah, thank you. I have more questions, but I'll join the queue. Thank you.
Thank you. The next question is from the line of Amit Parikh, an individual investor. Please go ahead.
Hello. Good evening, sir. Am I audible?
Your voice is low, sir. Can you please switch to the handset?
Just a minute, sir. Good evening, sir. Am I audible?
Yes, please go ahead.
Hello, sir. I have a question regarding PAT to AUM ratio, sir. Okay. our PAT to AUM ratio seems very low as compared to comparable NBFCs, sir. Why is it so?
Sir, who you will think is a comparable NBFC for us?
Sir, take for instance, I have compared with five-star business finance and also with Bajaj Finance Limited, wherein the PAT to AUM ratio for...
Of course, sir. Bajaj has been in existence for almost 40 plus years, and Five Star has been in existence for 16 plus years. We have been in existence for 5 years, of which 2.5 years were lost between the COVID crisis and DHFL and credit crisis, right? So we have early invested heavily in our operating infrastructure, and that is paying off over a period of time. So these are not apple-to-apple comparison, and that's why a company which delivered 7 crore PAT in 22, 40 crore in 23, and now delivered almost 56 crore in first half and would grow. I think so we are the fastest both AUM creator and, in terms of the absolute profitability, by vintage, if you compare, we are delivering an exceptional performance.
So, sir, take for instance, as and when Bajaj Finance had same comparable AUM as compared to Ugro, okay, it was in financial year 10-11, okay, when it closed its AUM book at 7573 crores. That time, even at that time, it used to do 250-300 crores of PAT, sir, and we are nowhere that number.
Of course, sir. But
on a recent TV interview also, you have said that you will be doing approximate 120-125 crores of PAT this year, and for next year you have guided doubling the profitability, right?
Yeah. So, sir, I think so this question is actually every company has its own journey, and every company has its own growth path. Absolute profitability and comparable with other established players, I don't think so. Like very different. I think so. It's our aspiration is to deliver top quartile performance given our vintage. We have said very clearly by end of 2025, we would be a top quartile performance with 30% AUM growth in the band of 16 to 18% of ROE for 4% of ROA, and we are gradually establishing that. There are different time and era, cost of capital, vintage, promoter advantages. So you cannot compare the two things by that logic. There are other companies which have low profitability but are actually doing fairly well in terms of their enterprise value. So that's why I think it's an uncomparable thing. I think so we are where we are. We feel very satisfied that we are delivering to what we have targeted for ourselves.
Sir, previously you have said that you are targeting AUM size of 20,000 crores by FY25, right? Now recently you have trimmed down your guidance to approximate 17,000 crores to 18,000 crores. And on that also, what I'm going to understand is operating leverage not working for us, even though we scale up at a very speedy pace, but operating leverage is not working for us, sir.
I think the operating leverage for us is working in what we believe. The target of a 10,000 crore or 20,000 crores is an aspirational target. We might achieve that as well, but as a publicly listed company, we have to deliver comparable performance from a very established set of players, what you were asking in your first set of questions. So in order to achieve that, I said, if we were to sacrifice AUM growth to a profitability, we'll do that. But our operating leverage has kicked in, and that's why from a 40 crore of PAT last year, we have a 56 crore of PAT in first half itself. This is the sheer function of an operating leverage.
Sir, just last question I would like to ask. Sir, just last question there, sir.
No, sir. Please, can you return to the question queue?
Sir, follow-up question on what sir has said, I would just like to ask. No different question from this, sir. Okay? Recently in a team interview, you have also said that there will come a time when you will enjoy a valuation which would be north of Bajaj Finance valuation itself also, sir. So what made you deliver that kind of statement then?
I have not said this. I don't compare valuations of the companies.
Sir, you have said it in a recent TV interview, sir, wherein you said that you will produce such kind of cash flows that this 7-8 times price to book also will not be a valuation to compare to Ugro, sir. What made you to deliver such kind of statement then, sir?
So let me clarify. If I said in a media interview you say different thing, I said the best performing companies which are liked by public market investors have delivered three things: a very predictable growth rate, predictable credit cost, and a sustainable business model. If you deliver predictable growth rate, predictable credit cost, and a sustainable business model which can attract capital, you enjoy the best multiple of that. I said Bajaj has achieved that. That's why it is trades at a very high multiple. Our aspiration definitely would be to be in that peer set. So once we achieve that in next few years, we should command that value is our aspiration.
Okay, sir. Okay. Thanks a lot.
Thank you. The next question is from the line of Ruchita Khadge from iWealth. Please go ahead.
Good evening, sir, and congratulations on a good set of numbers. Sir, my question was mostly on the credit quality. So currently our gross NPAs are at around 2.85% on our on-book AUM. So where do we see this going ahead? Let's say for this year and the next financial year, if you can give some kind of clarity on that.
So overall, on an AUM basis, our models and our plan is to be around 2% on a steady state basis. Now, on a steady state basis, we have also said that 50% of our AUM would be off book. So that should roughly translate to 3 to 3.5% of GNPAs on book on a steady state basis.
Understood. That's also from my side. Thank you.
Thank you. The next question is from the line of Rohit Shah, an individual investor. Please go ahead.
Yeah, hi. Thank you for taking my question. I just had a quick question. What is the total number of active customers currently?
Close to 62,000.
Close to 62,000. And how many have been added in the quarter?
So roughly we are adding 16,000 every quarter.
Okay, got it. Okay. And the last question I had, this is more just to understand the collection. So when you have in the machinery finance business, when you have your collateral as machinery, can you talk about your experiences in actually collecting in case of non-payment? How liquid is this collateral? How good is this collateral? And what is the LTV usually on a machinery loan?
So as a strategy, when we started the productive asset business, or what we call machinery loan business, we said we will only fund machineries which can be sold in isolation individually. We will not fund a part of a large machinery set. And we typically machineries are categorized by the categories of OEMs, and we only fund the top quality, the top standard OEMs. So our experience, very limited experience so far, because the portfolio is behaving very well. But a few customers where we had to pick up the machinery and resell it, the experience has been quite decent. Our relationship with the OEM has also helped, and informally they help us find a buyer.
Got you. And is there a target LTV usually in such kind of loans?
Typically the LTVs are up to 80-85%, but we also built as a pilot a portfolio where we gave an LTV of around 100%, and that is the best performing portfolio so far.
I see. Okay. All right. Thank you. That's all from my side.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Sachindra Nath for closing comments.
Thank you very much. I know a lot of you had follow-up questions. As a management team, we are we will be happy to answer them bilaterally as well. Our investor relationship led by Sneha and Janan would be happy to answer any question. Please feel free to write to us, or send us any communication in any form. We'll be happy to answer. Thank you. Thank you all for joining this call and listening to us patiently.
Thank you. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.